All right, let's get right into it. We all think of gold ETFs as the go-to modern way to own gold, right? But what if I told you there's a hidden flaw, something in the fine print that's quietly chipping away at your investment year after year? Look, we all know gold is that safe bet, the bedrock of a solid portfolio. No one's arguing with that. But the real question, the one you should be asking yourself is, are you really buying it the smartest way possible? And that's exactly what this is all about. We're going to pull back the curtain on this one little detail that almost everyone misses. And by the end of this, you'll know exactly how to spot the best gold ETF for your money. So, first things first, let's just quickly recap why gold ETFs became such a big deal. I mean, compared to buying actual physical gold, they are a total game changer. I mean, just look at the difference. Physical gold, you've got those crazy 10 to 25% making charges. You're never totally sure about the purity. And then there's the whole stress of where to store it safely. ETFs, on the other hand, seem to solve everything. Zero making charges, 99.5% certified purity, and it's all tucked away in a bank vault. Sounds perfect, right? Well, not quite. And this is where we get to the heart of the matter. It's something I like to call the erosion problem. And honestly, understanding this one little thing is what separates the average investor from a really sharp one. It all boils down to this thing called the expense ratio. Now, every fund charges one, but with gold ETFs, there's a huge twist. They don't just bill you or take it from your bank account. Nope. Instead, they literally shave off a tiny, tiny piece of the actual gold sitting in the vault to pay their fees. And what does that mean for you? It means every single year, each unit you own represents just a little bit less gold than it did the year before. It's a slow, silent leak. That's the erosion problem. And it's happening right now, inside your portfolio, whether you realize it or not. This might sound small, but let's look at a real-life example to see just how damaging it is over time. Take Nippon's Gold Bees, one of the most popular ones. Back when it launched in 2007, a nice round 100 units got you exactly 1 gram of gold. Fast forward to 2015, you suddenly needed 107 units. And today, you need a whopping 121 units to get that exact same gram of gold. Just think about that for a second. Your original investment has been diluted by over 17%. That is a massive chunk of your returns just gone. And the sneaky part is you never see it. It's not a fee on your statement. It's just this invisible drag on your performance. Okay, so that's the problem. How in the world do you get around it? Well, the solution is actually pretty simple. It all comes down to how old the fund is. The logic here is really clear. Think of it like a slow leak. A fund that's been around for 20 years has had 20 years of leakage. A fund that just started a couple of years ago, it's barely had any time for that erosion to happen, so its price tracks the real price of gold way more accurately. All right, let's put that to the test. Let's look at a much newer fund, the Tata Gold ETF. It only launched in 2022. So to buy 1 gram of gold using this ETF, it would cost you 16,715 rupees. And the actual price of gold on that day? 16,700 rupees. The difference is basically nothing. We're talking about a tracking gap of less than 0.1%. That's what you get when you don't have decades of erosion. Okay, so now you have the secret sauce. You know about the erosion problem. So let's use this knowledge to pick a winner and bust a really common myth that trips up so many investors. All right, here it is. The biggest myth out there. People look at the list of ETFs and they see one with a unit price of, say, 15 rupees and another at 130 rupees. And they think, wow, the 15 rupee one is so much cheaper. That's the bargain. But that is completely wrong. And this table shows you exactly why. Yeah, look at the unit prices. They're all over the map. You've got Nippon up at a 138 and Tata way down at 15. But then look at the most important column, the actual costs to buy 1 gram of gold. Suddenly, they're almost identical. That cheap unit price just means you have to buy way, way more units to get the same amount of gold. It's an illusion. So here's the bottom line. The one thing you need to remember. The price per unit is totally meaningless. Just ignore it. The only number that matters is the cost per gram. That tells you the real story. All right, so we've debunked the big myth. We understand the erosion problem. Now what? Let's turn all this theory into a practical, step-by-step plan you can actually use. So looking at all the evidence, if you're a long-term investor starting a new SIP right now in 2026, the Tata Gold ETF is really the standout choice. Why? Simple. It's the newest, so it has the least past erosion, and it has one of the lowest expense ratios, which means its future erosion will be super slow. It's the best of both worlds.
And here's a smart way to go about it. You don't have to go all in at once. You can use a phased approach. Start small, maybe with just a 500 or 1,000 rupee SIP to get in the game. Then, if the price of gold takes a dip, you get a little more confident and bump up your SIP. If there's a really big dip, that's your chance to be aggressive. This way, you're not trying to be a genius and time the market, you're just smartly averaging your cost over time.
So, let's just recap. We saw how one tiny hidden fee, paid in a way almost nobody notices, wiped out more than 17% of an investment's value. That's pretty crazy when you think about it. And it should make you ask a really important question. If this is happening in your gold fund, what other hidden gremlins are eating away at the rest of your portfolio?